All right, and welcome everybody. Thank you so much for joining us this evening. We're so glad that you're here. I know that we're all really busy. I want to be respectful of your time, so we are going to get started. So first and foremost, we're going to go over a few housekeeping items. First and foremost, we are going to engage with some polls. So we would really appreciate it if you can participate in those just to see what your understanding is on different topics or for us to know really who is in the audience. We might ask you to raise your hand, and so that could be found in the control panel of the GoToWebinar platform. And so that looks like this icon here. And then throughout the presentation, we will have, or you will have the opportunity to ask questions. And so on this platform, there is no chat feature. We use what's called the question box. And so you can drop your question in there. My colleague, Brianna Guerra, is assisting with me tonight. And so she will be able to answer questions, or we can always address questions at the end if you prefer as well. The last icon that we have here is the handouts icon. So we do have a couple of handouts for you tonight. One of them is a flyer for balance that we'll get into at the end of the presentation. And then the other is a sample of a credit report from Experience. So you have that accessible to you. And then I will give you some time to look over this disclaimer. And so this essentially says that this presentation is for informational purposes, and we're not here to give any type of advice. So if you do need that, we do recommend that you consult a professional. All right, and so today's topic, Credit 101, is, I think, really fascinating. And of course, it is something that affects us all. And so today I have the pleasure of facilitating this presentation. My name is Priscilla Olvera, and I am the Community Education Director here at A+, and I am a certified credit union financial counselor. This is personally one of my favorite topics. So again, I'm just really excited to be here and for you all to join us tonight. So to limit distractions, I am going to turn off my camera and we will dive right in because we have a lot to cover. So the first thing that we'll do is we will launch a poll. So having good credit history would help you qualify for. The responses are an apartment, affordable insurance plan, a phone contract, your dream job, or all of the above. Excellent, and I will give you a little more time to cast your votes. So we will close in 5, 4, 3, 2, and 1. Excellent. So you should be seeing the results. And so 75% of us said all of the above, and that is correct. And so this really just shows how credit really impacts us all in different ways, maybe more than we actually think. And we'll get into that here too. Credit score, the way that we want to think about it is a credit score is like a GPA, like when we were in school, right? It's a cumulative grade based on how we do in different classes, in this case, how we do with different credit accounts. A credit report is similar to a financial report card as well. Our credit report really is just a record of all of the financial transactions that take place only when it comes to credit. So if we're thinking about it, this could have personal loans, it could have credit cards. And so all of this is something that is on there and it stays on there. And of course, lenders and other entities have access to this report. So again, obviously the credit report is used by lenders to, one, not only approve you for loans, but it also determines the interest rate, it determines the terms of the loan, Additionally, it could be used for housing. So if you want to rent an apartment, of course, you have to have good credit. Otherwise, you may need a co-signer on there. Employers will use this. Insurance companies will use it to determine their rates, which I don't think is widely known. And then, of course, utility companies, they might look at your credit report and your credit score to see whether or not you may have to pay a deposit. Right? And so having good credit really helps us just pay the least amount possible for things, right? And really just enables us to have access to things as we need them. So something that I found interesting, this is from a study that was done by Toby Stanger, and it was how to save on car insurance. But he basically went into a bunch of insurance sites, right, and did a bunch of quotes, messed with the inputs on that. And what he found was that a couple with poor credit actually ended up paying more than somebody who has a teen driver or somebody who has 2 DWIs, which I thought was fascinating. And so again, this just illustrates how important having good credit is. The report, your credit score is derived from the report. And so this is what a sample looks like. It'll have your personal information on there. Every report has a number so that you're able to reference it if you need to dispute anything or have questions about it. And then it'll have any negative information, and then it'll start listing accounts as well. And so that's an example of a public record there. So an adverse account is when we have an account that is either at least 30 days past due or 60 days or 90 days. That, as you can see, is reported here in the status. But other information that is available, we can see whether that's a loan that you're going to just, pay and then it's done, or if it's revolving like a credit card. We can see the terms, your monthly payment, whether there's somebody else on there, what the credit limit is, what the balances are. And so that really helps us with when it comes to making lending decisions, of course. Here is an example of a satisfactory account. And so we could see in the status that it says open, never late. On some reports, what you'll see is just a bunch of boxes with a bunch of months, and it'll show green, right, if it is paid on time. And so that's what we want to see, is that it's always paid on time. So how do we obtain our credit report? And my colleague Brianna will drop this link in the chat, but we all have access to our credit report for free thanks to the Fair Credit Reporting Act. And so you can get one from each of the credit bureaus annually at no cost. And since COVID, they've actually been doing weekly credit reports. So if you did want to go in there and pull it weekly and keep up with it, that is an option. And this does not impact you in any way. So I encourage you all to do that if it's been a while since you've looked at that report, just to make sure everything is reported accurately. So the credit score we talked about a little bit earlier is like a GPA, right? So it's looking at all of your credit accounts, and then it's based on a formula going to generate this score. And that really just tells lenders and other entities how likely you are to repay something. And the range is typically 300 to 850, where 850 or those higher scores are better, right? That's an indication that you are likely to pay back on time. And so most likely you will qualify for better terms, better interest rates. And by terms, I could also mean, you can have a loan for 7, 8, a mortgage for 30 years, right? Because you don't pose a lot of risk, where maybe somebody who has a lower credit score may not qualify for terms that long because a lot could change in that time. Which of these actions will affect your credit score? So I do think there are some misconceptions sometimes, and so we are going to get a couple of responses on there, see what you think. We have applying for a job, checking your own credit, getting married, or co-signing credit applications. So 56% of us have voted. We'll see if we can get the majority of us to vote. And we will close in 5, 4, 3, 2, and 1. So we got to 80%. Fantastic. And so we all selected the same answer, co-signing credit applications, which is correct. And so applying for a job or when you go and do an insurance quote, those are soft pulls. And so because you're not applying for credit, that doesn't impact your credit score. Checking your own credit, as I mentioned earlier, that doesn't impact you either. Getting married, you each will have your individual accounts. And so unless you're on a loan together, one person's credit does not impact the other. But applying for credit will affect your credit score, and typically it'll drop your credit score, at least initially when you apply. Excellent. So obtaining your credit score, how do we get this? Number one option would be to buy it from the credit bureaus. That's one, but there are some other free options as well. So many financial services providers, whether it be your financial institution or your credit card company, now provide credit scores. A+ provides credit scores, and we're going to talk about that toward the end as well. But there are also, you may have heard of sites like this, like Credit Karma, Credit Sesame. Those will provide a version of your score. And what I like about those, even though what they do is they kind of spam you with offers, but the nice thing with any of these is that you get to see how you're trending, right? If your credit score is going up, if your credit score is going down. A lot of the times they alert you if there's a new account open, and so that also is helpful for staying on top of your accounts and ensuring there isn't fraud on your account. So there's a lot of benefits to monitoring your credit score. Number two, there are 5 main factors that influence your score. So when we think about how do we improve our score, we first have to understand what impacts our score. And so, as I mentioned, there are different scoring models. You may have heard of FICO. That's one of the most popular. Vantage score is another one that's very commonly used. So each of these, you'll notice, they have different weights on the factors, but they're very similar. So FICO payment history is about 35%. So it looks at whether you're making your payments, whether you're making payments on time. The amounts owed, 30%, that looks at how much do you owe overall? How much do you owe on a particular account? Is your credit card maxed out? Length of credit history, that looks at how long you've had accounts, because the more data there is, right, the more accurate of a prediction can be made, and so that is beneficial. Credit mix looks at what types of accounts do you have? Do you have an auto loan, a mortgage, a credit card? Really, that just helps predict what you would do with those products in the future, right? Whether you can handle those products. And then new credit is how often you're applying for loans. Are you applying for them frequently all at once? That's not a very good sign. So that's FICO. And then you can see on the other side, Vantage score, payment history is 41%. Age and mix of credit, which is some of the other ones, 20%. Credit utilization is 20%. And I think I have a slide that covers this one. New credit, balances, available credit, they're all very similar. They just emphasize things a little bit differently. One thing to keep in mind, this is for FICO, but what happens is that it's going to look at the most recent information and weigh that a little heavier. So current to 12 months is 40%, 13 to 24 months, 30%, so on and so forth. And so really, right, what you're doing now is a better reflection of what you're going to be doing in the near future versus what you did 3 years ago, right? That's the way to think about it. The good thing is, if you do make a mistake, it starts to impact you less with time. But here's what I mentioned about that credit utilization ratio. This, you can go and look at your lines of credit and calculate this for yourself. The formula is your current balance over your available credit limit. So if you have a credit card, for example, that has a $10,000 limit, ideally, let's say you have a balance of $3,000, that's 30%. And ideally, that's where we want to be. Experts recommend that you keep it at or below 30%. Because again, that factors into how much is available, and so keeping that low shows you're responsible, you're not having to max out your cards, so on and so forth. What initial impact does opening a new credit account have on your credit score? And I kind of laugh because I just mentioned this, so let's see if you picked up on that one. What initial impact does opening a new credit account have? So no effect, negative impact, or positive impact. I like what I'm seeing. I like what I'm seeing. 30% of us have voted. Let's see if we can get a few more to cast their vote. And we will close in 5, 4, 3, 2, 1. So when I say that, the answers start changing a little bit. So in this one, we have a little bit of a mix, which I like because it really kind of depends. So initially, yes, it does have a negative impact. So typically, if we apply for a loan, your score will drop a little bit. But I like that there was also has a positive impact because really a credit account over time has the potential to be used as a tool to really build and improve your credit, right? So negative impact initially, but over time could be a positive impact. Number 3, your credit reports and credit scores from the 3 bureaus will be different. So if you are already looking at these sites that were mentioned earlier, you may have noticed that there's some variances. One, as I mentioned, there are different models, so it all depends on what the model is. But even then, it also depends because the information on the report comes from 3 different agencies, right? 3 different credit bureaus. And so that's a factor. When it comes to FICO too, there's also industry specific scores. And so if you go to the dealership, if you're going to apply for a house and if you've already done that, maybe your credit score was different than what you saw online. That's pretty common because there are specific scores for auto, for mortgage, and for credit cards. So it's going to factor things a little bit differently, which means the score is going to be different than what you might see somewhere else. But the 3 bureaus are Equifax, Experian, and TransUnion. So when we pull our report, that's who's going to provide it for us. And again, they all use different formulas, but they all are similar. So some things that can impact those scores and that explains why there could be differences. They could be from different dates. As we see in this example, one of them was pulled in February, one is from March, the other one was from another date in March. So that may be it. Maybe it's using different scoring models, Vantage Score, 4 or Vantage Score 3, or there's a lot of different ones out there. And then also lenders will report to usually one bureau. So if A+, for example, reports to Equifax, then it takes a little bit for that bureau to report to TransUnion and to Experian, right? So that there's a bit of a delay there, which could also cause those variances. But why does this matter? It of course impacts us and our bottom line, right? The higher the score, the better. Each lender will have a matrix that looks like this. This I just pulled from online a while back. So, maybe I'm sure that these interest rates are higher now due to just the economic environment. But what we generally see is, again, the higher our credit score, the lower the rate. Also, as we begin to push out the term, the amount of time, then of course that means, again, more things could change. There's more risk. That means the rates are going to be higher the more we push out that loan. So as we think about borrowing and our options, that's just something that we have to keep in mind. And of course, the rates for the poor credit score are very different, right, than some of the other higher tier scores. So that really impacts what we pay. And we're going to look at that. Number 4, your credit helps determine if you get a loan and how much you will pay in interest. The higher the score, the lower the risk, the lower the interest rate, and vice versa. The lower the score, the higher the risk, the higher the interest rate. So I like this example because this puts some numbers in front of us to be able to compare. And so what we have is an example for a $300,000 home, 30-year fixed rate loan, and a car loan for $20,000 for 36 months. And we saw the matrix earlier, 36 months is still low, right? It could go up to 84. So imagine, having a longer term or having a larger loan balance, because houses are much more sometimes. But again, this is an example. We have excellent, we have fair, and we have poor. And for the house, we have some rates. Again, this was pulled from Lending Club, just as an example. 3.7, we'd pay 200,000 in interest over 30 years. 5.35, 303, 9.57 with 30% down, we'd pay 418,000. So this is why it's so important to work on credit, and I'm sure we all have an idea, right? And so it's a lot of money on the table that we could be having to pay. Buying a car, same thing. Car loans are usually also a little less expensive, but you can see even here, there's a $4,000 difference between the poor score and the excellent score. So what are some of the things that a lender looks at? One, they're going to look at your credit history and your score, stability factors, so how long you've been at a job, how long you've been in your home, right? Because all of this is just looking at risk, and if things are the same and your credit is about the same, all of those are just, they're able to better predict what will happen in the future. Comparable debt. So if you've had this type of loan in the past, how did you do with it? Can you handle it? Are your debts increasing recently? Are you taking on a lot of debt too soon? And of course, the length of history and your relationship with that financial institution can also be considered. So are there a lot of NSF fees, collections? How long have you built how long have you been a member, and how has that relationship been over the course of that time? And so when we talk about loans, we might also talk or hear about the 4 C's of credit. So it's similar to the previous slide. Character looks at, again, whether you're trustworthy, you're paying things back on time. Capacity, this is really looking at your income. There's all kinds of ratios in the financial industry too, that guide loans, right? So with the housing, right, that the home can't be over a certain percentage of your income. There's things that we have to adhere to, regulations, and so that also goes into capacity. Capital, so are there items of value that you could easily convert to cash to pay off your debt, right? So when you apply for a mortgage, for example, they'll take your retirement statements and things of that nature, because again, should you need it, you technically have funds that you can tap into if in the worst case scenario. And then the last one, collateral, are there assets of value that lenders can take if you don't pay back as promised? Like a car or a home, right? That can be sold and then used to offset any balance that you may have on a loan that you're unable to pay. Last one is your credit score affected when someone obtains a copy of your credit report. This is another like, did you listen? Or maybe a trick question, I realize. Okay, so 70% of us have voted. We'll give you 5 more seconds. So 5, 4, 3, 2, and 1. Absolutely, it kind of depends, right? So if you are applying for any type of credit, a loan, a credit card, then yes, it does affect you. If it's an employer, an insurance company, yourself checking it, then it doesn't impact you. And one thing that I also want to note is that um, sometimes it also recognizes in some models, like FICO, recognize when you're rate shopping. So a lot of the times, if you apply to different institutions within a certain period, usually 2 weeks, but it depends on the loan product, then it doesn't impact you as much versus if you had applied, 1 month and then 3 months later. So that's something to keep in mind too, is if you are rate shopping for like an auto loan, a mortgage, if you want to compare your options, you want to apply around the same time so that it doesn't impact you as much. Number 5, you need to use credit to build credit. So some tips: start small, just to make sure that you can handle it. And especially, I think, people that haven't had experience with credit, or young people that are just starting out, right? It's always good to just start small. If you're unable to qualify for a loan, maybe you've already applied for a personal loan and credit card, you keep getting denied, then a good option would be to apply for a secure credit card. And basically with this one, you have to put a deposit down, maybe $300 or something in that range, and you're essentially borrowing against your own money. Um, so it's locked away, and you're borrowing against it, you're making payments, it becomes available again, just like a regular credit card. And that'll help you build your credit history with time. And then once you feel comfortable and it's in a good place, then we can apply for a regular account. So that's one option. Another one is if depending on your product, right? Maybe you need a car loan, and someone is willing and able to be a co-signer for you. That's another way to put your name, to have credit in your name, and just having somebody help you qualify for that. Just know, again, this is a kind of a two-way street. Whatever you do impacts them. When we co-sign, or when someone is a co-signer for us, we just have to be very, very careful about that. And then the last one is becoming an authorized user. And so I don't know if this is particular scoring models, but I know this has helped my husband and I. What this means basically is you might have a credit card. Maybe you've had it for many years. My parents had one for like 20 years, and they added me on there. But basically, you add someone onto your credit card, again, assuming that you have a good, healthy history with that card, and then it starts reporting under their name as well. So there's a lot of credit cards that do that, just based on my experience, but you can always check with your financial institution, that provider, and see what they do and find out. But again, it'll start reporting for that person, and so it's a way to help them build his credit history. So an option to look into. And then just when it comes to either improving or building credit, we don't want to borrow just to borrow, right? Use or apply for a product that is actually going to benefit you, whether it be, again, a car loan, or if you're actually going to use the credit card, then get that. Just ask yourself if it makes sense for you. Always make your payments on time, right? Try to pay your balance off in full, because we can get into some trouble if we do apply for that credit card and it's very tempting to use it and spend more than we have available in our account. And then limit the number of open accounts. Again, if you apply for too many things all at once, it's a bit of a red flag for lenders and it may not look good. So always try to limit those accounts. I know, I think of my mom, stores, you'll go and at checkout, they'll offer you coupons, a one-time coupon if you open an account. And that's not always the best thing for us, right? That one-time coupon if we're never ever going to use that. So things like that we want to keep in mind. What this means, what this doesn't mean, is you don't have to carry a balance. I think there are misconceptions that people think that they have to show that they have a balance to show that the account is active to build credit history. That's not true, right? Even if you don't use it, an account stays active, or if you use it periodically, the account stays active, and that's helping you build your credit history. So always try to pay your balances down. You don't have to be in debt, and you're not rewarded for having debt. I mean, there are perks to certain products like credit cards. They might have rewards, things like that. But again, try to just be very cautious when it comes to using them. That way, you don't kind of dig a hole for yourself, because credit cards, as we know, they have some of the highest interest rates, and so it's very easy for those balances to grow. Number 6, credit reports have errors and it's your responsibility to fix them. What types of errors could there be? There could be account-related errors. It might show that you have an account that's open when you've actually paid it off. It might show an account with a higher balance than what you show when you log in or when you call. There could be derogatory mark errors, so maybe it shows that something is past due or in collections when that's not the case, or maybe you've already paid it off and it doesn't show it's been paid off. And then there are personal information errors. Maybe your name isn't right or your address isn't right. Things like that. All of these errors could potentially harm you, right? If your balances show higher than they are, or if there's a late payment that was made on time, it could be bringing your score down. So we definitely want to correct those as soon as we're able to, especially if we're getting ready to apply for a loan product. And then it could also be a sign of fraud. A fraud is very prevalent. And if people have the right information, they're able to open an account in your name. So again, staying on top of your credit report is a good way to watch out for that. So what do we do? One, we have the right to know what's in your file. So you have the right to get your credit report. You have the right to dispute it, right? To say that that's incorrect. Another thing you can do is limit pre-screen offers. So a lot of the times we get these credit card offers or auto loan offers, and maybe we just don't want it to get into the wrong hands. What we can do is go to optoutprescreen.com. Brianna is going to drop that link in the chat. But again, that's just one way that we can try to combat that fraud. But what you will do is review the report, mark anything that looks off, and then the credit reporting agencies have to correct it. They have to investigate it. And if anything's wrong or incomplete, or they can't verify it, maybe there's an account in collections and it's been passed on from company to company to company, and they can't verify the original lender, or there's not enough information, right? That actually needs to come off if it can be verified. They also cannot report outdated negative information. So if there is something on there, we're going to talk about limits, then that's another thing that we need to dispute. So the credit bureaus have 30 days, typically, sometimes up to 45, but typically 30 to correct or remove any errors. So again, you identify them, you file a dispute. Brianna is going to drop a link to our life guidance page that has this process and the links to each of the credit bureaus and the numbers so that it's easily accessible to you. But once you file your dispute, the credit bureau again will investigate. They'll go to the source, which is the creditor, the financial institution. That financial institution or credit card company or other company, they'll have to investigate, respond, and then they're going to make updates and notify you of what they found, all again within that 30-day time frame. And then a number 7, so the better your score, the harder you fall. It's unfortunate. How much could a 30-day delinquency cause a credit score to drop? So again, you didn't pay your payment, it was at least 30 days late. It really depends. And so the person who has impeccable history, who has no late payments, has a 780 FICO score, their score could drop 90 to 110 points because it's out of character. So again, it's a bit of a red flag. So that's going to harm that person versus someone who has that in their history, doesn't have a great credit score. It's something that is in character, so it doesn't affect them as much. Right, so their score could drop 60 to 80 points. So the reason why we show this is if you do have history and you're working hard to build that up, we have to take good care of it because these mistakes could harm us, and they could harm us for a bit, right? Late payments, again, after a year, 2 years, it starts to impact you less, but it'll at least be on your credit report for 7 years. Same thing with bankruptcy. Chapter 7 is actually 10 years, foreclosures, collections, all of that is on your credit report for 7 years. So we want to try to avoid those things as best we can. So that's the information that I had. We have a few minutes left and then we're going to get into the questions, but I wanted to share that we do again offer credit scores now. This is something we started doing recently. And so all our members have access to Vantage Score 4.0, again, at no cost to you, doesn't impact you, and that is more information can be found at this website, which Brianna will share in the chat as well. But it's very easy to enroll. It's very easy to unenroll if you don't want to see it anymore. So just again, a good way to kind of see how you're trending and keep up with your credit. Workshops, we do offer monthly workshops. Next month's topic will be budgeting is what we're hoping to do. So if you want to join us, check this link out. We also have on-demand webinar recordings, so we have a good library of information out there for you to view at your convenience. And then Balance, which is one of the handouts that we included today. This is our partner that provides financial education. They offer courses, articles, podcasts, videos, all for free. You can register for an account with them. But one of the best things that they offer is financial counseling. So they can do one-on-one calls with you. If you haven't pulled your credit report, have no idea how to do it, want some help, that's a resource that you have. Or maybe you're needing to file that dispute, have some questions, they can help with that. Or you're trying to navigate home ownership, right? They can help with all kinds of things, and it's all available to you at no cost. It's confidential. That's what I had prepared for you today. And so I want to open it up for questions and make sure that we answer questions that you might have. And one thing I didn't mention that I just thought of is we are recording today's presentation. So what we'll do is we will send a follow-up email tomorrow with a link to the recording along with some additional resources. So feel free to rewatch at your convenience, or if you think somebody could benefit from the information, you can forward that to them. So that will be going out tomorrow. So how long do student loans stay on a credit report? So credit reports, they will have your information there for a long time. So it's after an account is closed. I might depend on the scoring model, but it might be 10 years even after an account is closed that it stays on there if it has that positive history. And then negative history, as we saw, it'll be 7 years that it stays on there. But um, that's a good question. If you have positive history and you've paid them off, that's actually helping you for another 10 years. So I enrolled to see my credit score on the A+ app. Does the score renew every month on its own? So yes, so it will be updated on a monthly basis, and I think it's actually it might happen in just a day or two. So yes, it will be something you can check back monthly. Great question. Oh, thank you so much. Awesome. All right, so I don't see anything else. We'll actually stick around just in case there are more questions, but otherwise, I want to again thank you so much for attending. I know everyone lives really busy lives, so I really appreciate that you took time to join us this evening. All right, so we'll stick around for just a few minutes.